Today, we're diving into three of the most hyped stocks on the market: Palantir, Nvidia, and Tesla. But here's the twist. While everyone's talking about them, they might actually destroy your returns if you're not careful. Let's break down why the hype can be dangerous. Palantir is reshaping industries with its AI-driven data platforms. Nvidia is the king of AI chips. Tesla absolutely changed the car business, and they're changing energy. But there's one problem: sky-high expectations. Today, we'll take a look at why these three hyped-up stocks may not live up to the hype in the long run. In the world of investing, hype can lead to big wins or big losses. Palantir, Nvidia, and Tesla have been absolutely on fire for quite some time now. But are they about to burn out? Let's explore why these hyped-up stocks might not be the golden ticket that everyone thinks they are. Now, everyone, keep in mind, just because we talk about a stock and talk about how amazing the company is, that doesn't mean I'm buying them. It doesn't mean I've bought them. You need to watch the whole video and make sure you understand the words and comments I'm saying, because I'm trying to teach principle-driven investing, which means that a great story and great numbers have to come together in order to buy a company. The problem we have is on these three hype stocks, the story might be a little bit better than numbers on a couple of them. So let's check them out. Now, as a value investing channel, you might be wondering, well then, Paul, why are you looking at these? Guys, we react to what YouTube and our viewers want us to talk about. When we get requests for Palantir, Nvidia, Tesla, all these companies, we use these companies to then teach our principle-driven investing ideas. The great company at the wrong price is a bad investment. The key is merging the story and the numbers together. So let's check it out by starting with Palantir. Now, guys, Palantir is interesting, and the reason being is great margins, great founder, weirdo CEO who's a little too bitter about a lot of stuff, and amazing balance sheet. This is a company that's been on a tear. This company was at $45 back in February of 21, went all the way down to $5.83. In February of 21, when it was at 45, I said, hey, maybe I'm interested at $5. Never got to $5, got to $5.83. So therefore, I was out of it. But then it's gone on a tear since then. The good news is this company's balance sheet keeps getting better. Let's start with that right here. So first off, $176 billion market cap, $173 billion enterprise value. That means they have more cash on hand than debt. That's what's incredible about this business. Look at this, 81% gross margin. That means every extra dollar they sell, 81 cents will go to the bottom line before overhead and taxes. Do you know how high this number is? This is higher than Nvidia. This is higher than Microsoft. This is higher than Apple. This is higher than pretty much any company I can think of except for maybe Adobe. I think Adobe's is bigger. This is bigger than Google. This means this company can just keep adding profit and cash flow to the bottom line. And that is a deadly combination in the positive regard for a company. So let's check out their 8 pillars. Let's see what the 8 pillars are telling us. All right. So the 4 checks and 4 X's aren't as good as the story. Here are my big reservations. Forget about PE because they have a hard time showing earnings, but they have a great time showing free cash flow. Look at this, guys. In the last year, $1 billion of free cash flow. Last 5-year average, $381 million. They're growing their free cash flow like crazy. But look at this. So let's say this 5-year free cash flow is wrong, which it is. I mean, you can't sit there in a fast-growing company and based on the last 5 years. Let's make it the 1 year. It still makes this 5-year price of free cash flow around 150 times free cash flow. You might sit there and say, Paul, it's a growing business. I agree with you. The problem is, it's hard to spend 150 times free cash flow on a $176 billion market cap business and expect to make a lot of money. It could happen, but it's a very difficult task. If this was 1.76 billion, I'd be like, okay, there's a lot of runway there. There's a lot of valuation there to catch up with. And then you look at price to sales. Price to sales ratio of 67. As an example, I think Microsoft's currently around 12 or 13, give or take, and Microsoft should probably be around 8 or 9. Now, granted, they have better margins, but it's still a big number. The 67 times price to sales, the price to sales ratio is a great way to compare 2 companies within an industry. Why is one selling for 10 times sales, another one for 20, another one for 5, etc. It's a great way to understand this. And of course, the shares outstanding up 171%. Guys, this one's tough because When you have increased shares outstanding, what management is doing is they're saying, hey, listen, our stock's overpriced. Let's just give people what they want. We'll just issue them more stock, gets cash in our pocket. We don't have to take on debt. I get it. But as an investor, you're being diluted here. If a company had 10 shares outstanding 5 years ago, they now have 27. That is a 170% increase. A lot of people will say, no, Paul, it's 17. It is not. It is 27. It's almost tripling the number of shares outstanding. That hurts returns when you're being diluted. Now, Palantir's biggest challenge is its heavy reliance on a few large government contracts. Now, as time has gone on, they're trying to step away from that and get more. They're lowering their threshold for how much they want to get in a contract, and they're going to more corporations, things like that, and they've done a great job of doing that. And even though those government contracts can be lucrative, they do expose the company to significant risks. A change in government budgets, policy shifts like we just had happen with Trump taking over, or even controversies around its technology could hit revenue hard. Now, this lack of diversification leaves Palantir vulnerable if key contracts aren't renewed or if new opportunities don't materialize. And remember, when it comes to working with the government, those are long sales cycles. I love the fact that they're trying to get more corporate kind of contracts going into place, even if they're at lesser dollar amounts. Now, for value investors, the real question is always, what's Palantir worth? Now, sure, the potential is extremely exciting, but the best investments are made with patience and discipline. And without a clear path to diversified growth, Palantir might not fit every portfolio today. Now, if you go look at their 10Ks and their annual reports, they've done a great job of diversifying. There's absolutely no doubt about that. But you've also got to be willing to accept the fact that this diversification means smaller contracts, means growth will take more effort. It'll still happen, but it takes more effort. And for those of you who are willing to monitor those risks, the long-term prospects could make it worth watching. But remember, hype doesn't build wealth. Solid fundamentals and careful analysis does. Not overpaying for a great story is what's going to build wealth. Now remember, some of you guys, most of our viewers are not old enough to remember the dot-com boom. But back then, the story was incredible. The internet was changing the world, and it changed the world. For those of you who are 25 or 30, just think about since when you started using the internet to now, how different it is. I grew up in the 90s. That meant that I didn't even experience the internet in the first 6 or 7 years. From 96 to 97 was the first time we really started using the internet. I remember having to go to the library and go look up the encyclopedias and get information on things I was doing reports on. It absolutely changed the world. But 99% of dot-coms went bust. Amazon.com, one of the few dot-coms that made it, dropped 96% from its all-time high in 2000 back then. Intel and Cisco, these were the Nvidias and Palantirs and the Teslas of the world back then. People would say you are stupid and not having them in your portfolio. Both those companies have yet to overcome their 2000 peaks. They're still below the price they were back in 2000. And if I told you right now that people would say Intel and Cisco have to be part of your portfolio, what would you say to me? So guys, here's a great example. I'm pulling up Microsoft, Amazon, Cisco, and Intel. These are the companies that made it. And Microsoft and Amazon, as you know, have absolutely crushed it since 2000. But from January 1st, 2000, for 10 years until December 31st, 2009, here's what happened. Only one was up, and it was only up 76.71%. Amazon, 10 years later, had to fall 95% and rebound, and it was only up 76%. Microsoft still down 48%, Cisco down 55%, Intel down 50%. These did not include dividends. But overall, if you invested $1,000 in each one, here's the money you had. You had $530, you had $1,760, you had $450, and you had $500. So your $4,000 investment was now, let's call it $1,000, $1,500, $3,250 roughly. You were still down 20% in your money. That's hard. And by the way, guys, these are all companies that today are making several times more than they were back in 2000. That's what we're trying to teach about principle-driven investing. It doesn't mean don't buy these companies. It means buy them at the right price. And I always bring this example up. In 2011 and 12, when I was buying Microsoft, a tech CEO told me how stupid that was because Microsoft was dead. That's what we have to get to. So what are analysts saying about Palantir? It's interesting here. Their earnings per share are only up about double. Now, keep in mind, free cash flow is what really matters with Palantir right now. They show far more free cash flow than their earnings per share. And the revenue growth, 24, 21, 23, 19, 18%. So slowing, but guys, this is still a lot of revenue growth, taking them to $7.5 billion in 2029. That's big time numbers right there. So how do we marry these two things together? Good story, numbers, put them together. Well, we use our stock analyzer tool. Since we started this software 3 or 4 years ago, our stock analyzer tool has been used by our community members to analyze over 8,600 stocks. Guys, repeat, this does not mean the stock analyzer tool has been used 8,600 times. It has been used over 1 million times per year, but our users have used it on over 8,600 different companies. Last year alone was over 4,650 companies. It is an amazing way to merge a story and the numbers together, because in the stock analyzer tool, part of the story is what's the revenue growth? What's the profit margin going to be? What multiple should sell for in the future? That's putting it all together. And guys, when they analyze those 8,600 stocks, it's everywhere. Europe, Canada, US, all over the place. And we're adding more indices as we're talking. So when was the last time I did Palantir? And let's see what my analysis looked like. Now, guys, I went aggressive with them. I said 12, 18, and 24% revenue growth. Now, keep in mind, at the end of 5 years on the analyst estimates, they were at 18%. I'm giving them 18% for the next 10 years. Profit margin, I did 25, 32.5, and 40, and same with free cash flow. I'm matching them together because I assume over the next 10 years, those will come together. PE, I did 18, 22, and 26. Definitely deserves a higher PE. Definitely deserves a premium. And guys, 9% desired return. Now, I only do this to come up with some sort of intrinsic value. Give it the 9 or 10% number. For you guys out there, you need a higher desired return. That's going to give you your margin of safety that we need, because we're humans, we make mistakes, and we don't know the future. And third, if you're only trying to get 9 or 10%, buy a low-cost ETF and put it to bed. So we hit the analyze button. Boom. I have a low price of 9, high price of 48, middle price of 21. Guys, I have my watch list with a little bit of margin of safety at 15. But again, I have other issues with the company, but right now I will take a look further as it gets lower. Stock number 2, I don't know if you've heard of it, guys, Nvidia, another company that I don't own, but I'm excited to wait for the price and the story to match. Guys, incredible run in this company. Last 5 years up 2,100%, 1 year 130%, 10 years 27,000%. Incredible. $3.4 trillion market cap, essentially the same enterprise value. Great balance sheet again. And this is what I love. Look at this gross margin, 75%. Guys, it used to be like 60% to 65 on the high side. It's now 75%. Now, keep in mind, they've been the leader on these chips, but people are going to catch up. Just like EVs, Tesla led the way, but Tesla saw a dip in their sales last year. They had to give away a lot of concessions on cars to get people to buy them. That nobody stays number one forever. I told you about the example of Microsoft. People said to me it was dead. But these are the things to remember. Look at these high returns on capital. That means this company is a moat, and when they invest money in their business, they do very well. So let's check out the 8 pillars here. Let's check out this story and how it looks. Guys, what we love. Everything's a check except for valuation. And again, though, 5 year, guys, the last 5 years, they've averaged $18 billion in free cash flow. Last year, they did $56 billion. I could not care less about their 5-year average, unless I think their current revenue and profit are an anomaly and they'll go back down. I don't know enough about the industry to be able to determine that. It's not as clear as it was during COVID when shipping prices skyrocketed from $4,000 for a container to $25,000. You knew, okay, this is temporary. This could be permanent for Nvidia. It's more likely to be permanent than anything because Nvidia is the leader and everybody looks at them as the leader. And guys, I was a computer nerd back in the 90s. Nvidia has been the leader since the 90s on their chips. They do a great job with their graphics cards and everything. And that back then, they're only a 4 or 5-year-old company and they were killing it. Nvidia is a top quality business. There is zero doubt in my mind about that. They are the golden child for the tech world by riding that AI and GPU wave. It's a powerhouse, but the investing story does have some cracks worth examining. So first off, valuation sky high. Now, that's something different that we're talking about versus other channels. They won't even care about valuation. They'll bring valuation at the end or even not look at it at all. But you're a principle-driven investor. you have to realize that a good story at the wrong price is bad. A forward PE of 44 and a price to sales ratio of 29. Compare that to the sector's median of 23, and that's with a lot of hype. The stock is priced for perfection. When expectations are this lofty, even small cracks, even small stumbles can mean big drops. And then there's competition, AMD and even Intel, and even their own clients like Microsoft and Amazon are investing heavily in developing their own chips or cheaper alternatives. Add supply chain risk with heavy reliance on Taiwan Semiconductor, and you've got potential bottlenecks that could derail the profit and growth. And with US tightening export controls to China, these regulatory headwinds also loom out there. 17% of Nvidia's sales are to China. That's a big slice of revenue that's under threat. Nvidia, no doubt, incredible. But ask yourself, what is my margin of safety right now? If I pay this price today to get these numbers, even at a current price of free cash flow of 60 or whatever it's at, what is my margin of safety? Well, let's see what analysts say for the growth of the profit here. Well, what's interesting is they're going only from $3 per share to $5.95. That's the dip at the end. So big growth still, but only doubling in the next 5 years. I would have thought much higher than that. And revenue, guys, crushing it. Look, 117% increase in revenue this year, 52%, 22, 12, and 1. Now, keep in mind, number of analysts are going down, and there's a heavy bias towards this company. But I'm surprised to see that it falters off so quickly. I would have thought much, much higher. So it's that favorite time again, stock analyzer tool. Now, I always have a hard time with Nvidia because the growth story is so amazing. It's about how do I sit there and justify this growth story going forward? Guys, look at the revenue growth. I did 10, 20, and 30% for the next 10 years. 20% revenue growth is a lot for 10 years, guys. That would take its current revenue and take it to from $113 billion to almost $700 billion in the next 10 years. That's a lot. That's an awful lot of money. Is it possible? Sure. The question is it probable? When we invest, we're making calculated bets. Every time you invest money, there's a bet being made. It's just like this. If I flip the coin and gave you odds of 3 to 1, if it hits heads, you should be making that every single time because the chance is 2 to 1. So you can get a better payout than the odds. But it doesn't mean on any given roll, you're going to make money. That's the key here. Okay. I did 30, 40, and 50% profit margin, which by the way, guys, they're already at 50% in the last year. So am I being too conservative here? Maybe so. Is it going to come back down? I don't know. PE, I did 20, 25, and 30. Again, very high. These are probably low PEs for what people would have said about Intel, Microsoft, Amazon, and Cisco back in the day. But again, I'm going here to be aggressive, and my 9% desired return, which does not have any margin of safety. I want to repeat over and over again. To give you a reference point, back then, Microsoft's PE was 70. 10 years later, when people would have thought it'd be an even bigger company, which it was from revenue and profit, their PE was merely 20. So still a lot, but definitely not the 70 everybody thought it was. And in fact, since then, it has not hit 70. So that's what I mean when I say you got to temper your expectations about the future and don't rely on your past numbers. Now, guys, if you're like our other people in our community, the thousands of people in the community, and you love the stock analyzer tool, you love all the tools we use here, I'm sure you've been to everythingmoney.com to check it out. And you'll see there's a wait list. Today's software includes everything we have to offer in stocks, real estate, retirement, economic data, everything. But behind the scenes, we are making changes and they're actually going to affect finally right now. So soon, this software will be completely different than the software I made years ago that was built for myself and my team. So I could use it to help make me suitable investments in stocks and real estate and make the right decisions for my future self. But we've grown a crap ton. It's less about me and more about how I can better serve you in the community. And this is why we have developers working full-time to update our software as we go. We've already started launching some of these changes. So if you join today, we're going to allow you to be grandfathered in for life with everything I mentioned. And as long as you join that community before those changes are made, you will also stay in your pricing tier forever. So click on the link in the description below, change the way in which you look at money, become a more principle-driven investor, sleep better at night knowing you're making better decisions, and have a community of thousands of like-minded people that you can talk to every single day. So let's go down here, hit the analyze button, boom. Well, guys, what's interesting is 43 on the low side, 450 on the high side, 145, 47 in the middle. Now you might sit there and say, wow, it's all green, right? But how reasonable are these assumptions? Maybe they're good, maybe they're bad. We don't know. But I will tell you, these assumptions don't have any margin of safety in here. And that's why this 9% return needs to be modified. Now, a question that was asked to me recently was, Paul, you have to buy one stock, Palantir or Nvidia. So of course I go, oh, that's so hard to answer. And remember, what I'm going to say here is my thoughts that I think they're both overvalued. But with Palantir at least, they're showing immense free cash flow. Yes, their CEO is not nearly as good as Nvidia's CEO, but they have much more growth potential to grow into. Nvidia is at $3.5 trillion market cap. I mean, does it become $7 trillion? Yeah, it will eventually, but am I going to get that value? Palantir could easily keep just running and keep building on that momentum, keep driving that revenue and profit. So gun to my head, I have to pick one. I am picking Palantir, but nowhere, shape, form am I endorsing it at this price. Stock number 3. This is the one I love talking about because this is the one that years ago was the Nvidia of 5 years ago, Tesla. This is the company that you were stupid if you didn't have in your portfolio. Paul, how dumb you are. Now it's at all-time highs again. Hit all-time high a month ago, $488 per share. Guys, just back in April of last year, it was at $138. Highly volatile stock. What's interesting is sales were down in that year. They went from a 1.8 million sales to like 1.704 or something like that. They had to give away how much to get people to buy their car. There's no doubt in my mind that Tesla has changed the auto industry. You know what I love about Tesla also? No negotiation. I was just with my stepkids the other day telling them how much I hate buying cars. And their joke was, but Paul, you're always buying cars. I know, but I hate it. Why? Because I hate the haggling. I hate doing that. Tesla just says, this is the price. Want it? Take it or leave it. I love that. I hope that's how they change the car game for people. But guys, look at this. This company went nowhere for almost 3 years. Over 3 years, actually. Over 3 years. End of 21 and took till the end of 24 to hit its all-time high again. 3 years of doing nothing. What happened in that time frame? Let's look at where the revenue went in that time frame. Big time changes. 53 billion that year. 53 billion, 97 billion in the last 1 year. Almost doubled, I mean. Almost doubled. And this is an amazing company, like I said. But one big concern I have, the average car company sells for 0.5 to 1 time sales. They're at 15 times sales. Oh, Paul, it's not a car company. It's a tech company. Okay, well, Microsoft is also less than 15 times sales. And guess what? When 90% of your revenue or more comes from cars, you know what that makes you? It makes you a car company. Could they change that? Absolutely. They have the ability to do that. And you should value the tech portion of it different than the car portion of it. But to sit there and say it's a tech company blindly is even stummer than me saying it's a car company blindly. And I'm not saying it's just a car company. What I'm saying is 90% of its revenue comes from a car company, so you got to value it 90% as a car company. That 10% that's software may have a lot of potential, but you got to be able to value that separately and put them together. If you liked my impersonation of the tech bros, please comment below and say, Paul, that was awesome, or Paul, you're an idiot. So let's go to our 8 pillars and see what the story is here. Oh, 4 checks, 3 X's. Not much in terms of shares outstanding increase, 5.5%. I thought it'd be more than that. But guys, 5-year PE of 193, 5-year price of free cash flow 361. And here's the scary part. Their 5-year free cash flow is actually $4 billion. It's actually higher than last year's free cash flow. They're starting to act like a car company. Return on invested capital, 7%. Starting to look like a car company here. Gross margin, 18%. Oh boy, what does that look like? So let's look at it this way, guys. 18% gross margin. Ford, Honda, all those guys, 12 to 18%. That sounds like a car company. Software businesses, 55%, 60%, 68%, 70%, 80%. Or Adobe at 88%. Is this anywhere close to this? How much bigger does the tech portion have to be for their gross margin to become 40 or 50% selling this many cars? That's all I'm asking you. And when you look at Tesla, you do have to look beyond the hype. They have a stellar brand, but cracks are also forming in that growth story we said for last year. And we can't ignore red flags. We should not give every red flag equal attention. but their EV sales dropped 1.1% in 2024. That's small, but for a company that priced in sky-high multiples and sky-high growth, and literally just 3 or 4 years ago, people were saying it'll never stop growing. It'll probably be doing 10 million cars a year and be the biggest one in the next 10 or 15 years. Guys, the biggest car company in the world is Toyota. They sell 15 million cars a year. That means Tesla needs to grow 8x to overtake in the next 7 years to hit that lofty expectation that was made 3 or 4 years ago. Growth stocks need growth. There's also global competition, shaky government incentives, and the picture gets murkier and murkier. Lithium, nickel, cobalt, all these prices are soaring. These supply chain issues squeeze those margins, and Tesla could struggle to meet demand if bottlenecks persist. Even great businesses suffer when costs climb, especially when your gross margin is 18%. If you're a tech business, a real tech business, with 80% margin, okay, they take away 5%, you're fine. You're still at 75%. Not when you're at 18%, though. Take away 5%, and you go from a profitable company to unprofitable. Remember they kept talking about a $25,000 Tesla car? That's a dream still. Rising costs mean the focus on premium models, leaving price-sensitive buyers to competitors like BYD, which offers a $9,700 EV. That is why BYD is dominating in China. Even GM's EV sales have surged 50%. Plus, what happens when that $7,500 EV tax credit vanishes? Tesla isn't the underdog anymore. It's the target. Ask yourself, are you paying for the right growth? Or are you paying for hype? Remember, principle-driven investing means never overpaying for a good story. Stick to the fundamentals. Now let's see what these analysts think the fundamentals are going to do here in the future. Okay. $3.30 per share in profit, growing to $6.31, almost doubling in the next 3 or 4 years. Pretty solid. Revenue growth, still double digit. So maybe it's just a temporary fall along the way. Doesn't help the fact that Elon has endorsed Donald Trump, which every single person who loved Tesla before was a huge bleeding heart liberal. And now all of a sudden they had to sit there and cry and scream as their Teslas became this thing created by this terrible person called Elon Musk, who I think is absolutely brilliant. He's doing a lot of things right now, and that also is a risk. So let's look at our stock analyzer tool. I'm going to pull up Tesla, and let's see what assumptions I made. Guys, look how high I made these assumptions. I'm going to pull these back a little because I think I was doing this earlier for an example. Let's do 10, 15, and 20% growth. I'm going to do 12, 18, and 24% profit margins. So I'm going to assume that the car business stays, but their tech portion really grows, because they can't make 18% bottom line on a car business. Ferrari, which has 50% gross margin versus Tesla's 18%, their bottom line is about 20%. So this has to incorporate some tech in it. PE, I did 20, 25, and 30. I think it's a little high. Let's go with 17, 21, and 25. And let's hit the analyze button. And guys, after this video, if you want to see 3 stocks near their 52-week low to find value, please watch the next video. Boom. Low price of 93, high price of 530, middle price of 240. I think they're still priced for perfection. Thank you for your time.